great question. A couple of things. I'll go back to my favorite word, narrative, which are get powerful but usually wrong. But the narrative today is it's the end of the dollar. The dollar's losing its role as reserve currency. I don't agree with that at all. I can explain why that's not happening. But then I say to people, one of my favorite jazz songs from the Montreux Jazz Festival in 1968 is Compared to What was the name of the song. When people say, is the dollar going up or down? I say, compared to what? If you're comparing it to the euro, right now it's going down. It's probably going to stay down. That's not a sign of weakness in the dollar. It's really important for investors to understand. This is being engineered by the U.S. Treasury. This is part of Steve Moran's Mar-a-Lago Accord. You got to, go back a little bit, do your homework on what's actually going on in the White House. This is engineered. This is not that different from the petrodollar in 74 and the Plaza Accord in 85. So those are your precedent. Both of them devalued the dollar. So this is being engineered by the Treasury. So don't expect the dollar to go up. It does not mean the end of the world, the end of the role of the dollar as a reserve currency. My question is this: has it gone down against the euro? Yeah. So what? If you think the dollar's role as a store of value is in decline or about to collapse, what are you going to do? Say, hey, give me some euros, give me some yen. Do you really want German and Italian bonds and Japanese government bonds in a world where the dollar is collapsing? No, not at all. Because they're all, I call them, they're all survivors in the lifeboat. They're going to sink or swim together. It's not like one's going down, the others are not. They're all joined to the hip. So what is the alternative? If for whatever reason you want to diversify out of dollars, and I think that's always a good thing, you go to gold. And one quick footnote on that, there's been so much talk about the BRICS currency. The BRICS are going to have a new currency. It's going to be the end of the dollar again. More nonsense. The BRICS may have a currency in 10 or 15 years. We'll see. They're doing a lot of other things right, but launching a currency is not one of them. But they don't have to. They already have one. It's gold.
Yeah.
So the short answer to your question is gold is very much in demand. The central banks are buying it as fast as they can. I like the trade because with central bank buying, it kind of puts a floor under it. No guarantees, but it puts a floor under it. So I call it an asymmetric trade. You don't have much downside because the central banks are buyers, but you own all the upside. So that's a good position to be in. One last thing, it's a very strong gold market. It's going to get stronger. I see gold at $4,000 an ounce before the end of this year and going up from there. But we are not at the retail frenzy stage, which I lived through in January 1980. I mean, I worked at Citibank at the time. They had a mandatory lunch hour. They did. And as I used to walk up Lexington Avenue, maybe shop at Bloomingdale's back in the day, and I never did it once without seeing gold chain snatching. It would be like some woman would scream, you turn around, there's a guy, grab the chain around. That's how crazy people were about gold. We're not there yet. I'm not in favor of chain snatchings, but we may get to that mentality. But here's why. And again, very simple math. So let's say gold goes up $1,000 an ounce. Well, if you own 100 ounces, you just made $100,000. But to go from $3,000 to $4,000 is a 33% gain. To go from $9,000 to $10,000 is only an 11% gain. It's the same $1,000. You made the same $100,000 on your 100 ounces, but it gets easier as you go along. So people, this again, you gotta like have a little behavioral psychology behind this. People are like, oh, I made $1,000, another $1,000, another $1,000. But yes, that's the nominal amount, the dollar amount. But the percentage just keeps dropping because the denominator, the base, is larger, and it gets easier. So all of a sudden, you go, oh my goodness, 10, 11, 12, and that's what happens. That's the frenzy stage. If you have gold, I recommend 10% of your investable assets. Don't bet your home equity or your business, but whatever else you have, those are your investable assets. I recommend a 10% allocation. If you're not there, keep buying. If you don't have any, you have not missed the boat. This thing is just getting started. Right. Look, debt matters, deficits matter, and I wouldn't disagree with any of that. But I'm hearing and seeing so much about we have $38 trillion in debt. The debt to GDP ratio is at all-time high. The deficits, we were supposed to have this one big, beautiful bill to cut the deficits. The deficits are actually getting a little larger, at least in the short run. So this then it's a very short leap from there to this is the end of the dollar. The end of the dollar is always a reserve currency, et cetera, and the Great Reset. So that's the narrative. some of the facts are correct, and I agree with some of it, but I think the narrative goes completely off the rails. But let me explain why. I don't want to just say that. First of all, when you say 38, $39 trillion of debt, I'd be careful. It goes up a couple $1 million a minute.
Right. Right now, it's going up.
It's going up probably $1 million before we're done this interview. Yeah, it's a big number. But what does it mean? The way I explain that to people is, let's say you owe $50,000 on a MasterCard. Is that a lot of debt or not? Well, it depends on how much you make. If you make $20,000 and your interest rate is 28%, you're probably going broke. If you make $500,000, you just write a check and pay it off. In other words, the debt can only be considered large or small in relation to the resources, the income behind it. So with that very simple concept, I think everyone understands that. You do the same thing with the national debt, 38 trillion, yeah, big number. But what are the resources? Well, the resources is GDP, gross domestic product. And Nomi, you made the point that there are a lot of flaws in GDP measurement, and you're absolutely right. But it's kind of the best we have, and at least we have a good time series. So you have to compare the debt to the GDP. It's a ratio. Debt is the numerator, GDP is the denominator. What's that percentage? That percentage tells you if you're in trouble or not. So don't throw the big scary number at me without telling me what GDP is and what the ratio is. Now, the ratio is not good. Let's be clear. It's about 123% right now, all-time high, but not too far from where we were in 1945 at the end of World War II. There was about 115%, but it's close enough. Although I do say it was 115%, but at least we won the war.
Right.
We got something for the money. But it's at an all-time high actually. So, but what does that mean in terms of the role of the dollar? The dollar is always reserve currency. The dollar is store value, et cetera. And there, I think the analysis goes badly wrong. Now, a couple of things. What Trump is trying to do, and I think very few people really understand it. I've had the privilege of talking to during the transition, and then since then, members of the administration.
You were on the team.
I was on the team. Well, I was an advisor to the team. But put it this way, I spoke to transition team members. This is the way I would put it, including Peter Navarro and Kash Patel and others. They have a plan. It's the narrative you hear, again, I come back to the word narrative, but Wall Street loves narratives. They love a story. And if the story hangs together, everyone believes it. It's powerful. It doesn't mean it's right. And I'm kind of attacking the narrative a little bit. So the point is, the Trump plan, it seems chaotic. He says 500% tariffs on somebody. Then next day, well, it's only 100%. Well, then we're negotiating, could be 20, we're back to 100. And it seems chaotic, but it's all, it's kind of the art of the deal to some extent. But there is a coherent plan behind it. And what they're trying to do is lower that debt to GDP ratio. Now, can that be done? Well, we actually did it from 1945 to 1980. So it was a 35-year period. The debt to GDP ratio went from about 115% that I mentioned to 30%, which is very comfortable. That's like having the MasterCard but having a lot of money to pay it off. 30% was very comfortable. But during that period, that same 35-year period, the national debt quadrupled and the annual deficit quadrupled, but the debt to GDP ratio plunged from 115 approximately to 30. So again, it's not really about debt and deficits. It's about the ratio. We're not going to pay off the national debt. People say, we've got to pay off the national debt. Nonsense. The last time that was paid off was 1836 under Andrew Jackson. He actually did pay it off. That was the last time. We're not going to pay off the national debt. We don't have to. We just have to roll it over. We're not going to get rid of deficits. We don't have to. We just have to get them smaller in relation to the GDP. So it's all about that ratio. Now, the Trump administration has a plan to do that. If you can get the annual deficit at 3% of GDP or less, okay, you still have a deficit, you still have debt, but it's 3% of GDP or less. And then if you can get real growth at 3%, and I emphasize the word real because we have to tackle on inflation. Now, let's say inflation is 2%. So you really have to do 3 plus 2. I always promise to keep the math simple. So 3 plus 2 is 5% nominal growth. And everyone's like, oh, tell me about real growth. No, when you're dealing with debt, debt is nominal. I mean, real. I always translate things into real numbers. I think that's important. But if I owe you $1, I owe you $1. Whether it's worth more or less than it was 2 years ago, doesn't matter. I owe you $1. So when you're dealing in debt to GDP ratios, that's a nominal figure. So you take 3% real growth or higher, plus 2% inflation. So that's 5% nominal growth. So if the debt's growing at 3% and the GDP is growing at 5% nominal, what's happening to the ratio? it's going down. And that's all the market needs to see. The minute you go from 123 to 121 to 115, et cetera, if you're going down and B, on that path, the market will give you credit. They'll say, you're not going to 30% overnight. No, wait, it might take another 35 years. But the point is, it has been done before. It is doable, and that's what the Trump administration is trying to do. So for all those reasons, don't throw big, scary numbers at me. Tell me how it relates to income. Tell me what's going on with growth, which is a big part of it. Tell me what's happening to the ratio, and then I'll tell you if you're on the